Welcome to the Private Equity Experience Podcast, your backstage pass to the strategies, stories, and secrets that drive value in the PE universe. No filters, no fluff, just straight talk and expert insights to help you navigate the private equity world with confidence. And now your hosts, Ed Barton, Rory Liebhart, and Emily Sander.
Are we ready to rock and roll? This is like full of acronyms. It's like,
let's rock.
It's like the 1, 2, 3s of VC and Series ABC into PE firms. So here we go.
Yeah, to
Strap
the
in,
power of
boys
10.
and
Alphabet
girls.
scoop, baby.
Yeah.
But I think it's a good thing to talk about because, like, when I go, hey, private equity experience, we're talking about the PE world, and they're like, oh, so like VC, and I'm like, kind of, sort of. It's mostly like VC comes beforehand, generally, but how do we want to get people into this?
Or maybe never comes at all.
That's right.
A lot
That's
of
true,
times
too.
VC never shows up on the scene, or PE never shows up on the scene. It's like it's a whole ecosystem where some feed on the slower, weaker animals, and some
Are you the
chase-
Limpy Gazelle, or are
some
you
chase the fast or
Oh my God.
animals.
Mm-hmm.
Okay.
Yeah, I think
Okay.
there's some similarities,
idea.
i.e. that people that invest in these companies generally have an idea that they want to make a return on that investment. But, that's in some ways where the similarities might end. I mean, they are two different beasts, to take that analogy a step forward. And a lot of it has to do with where the company's at in its life cycle. A lot of it has to do with, some characteristics of the business, whether it makes money, doesn't make money, all these factors that go into VC
Okay.
versus PE.
So for like those who are like, what the heck?
Yeah.
What the hell are you talking about? VC is venture capital,
Yep.
and it's another source of capital. It's another source of investment. And it works in a lot of ways similar to PE. So like broad strokes, it's the same general structure and makeup.
Yeah.
It typically comes earlier in the process. So like startups might get angel investors, and then they might get VC funding, and then maybe they stay there forever, and maybe a subset of that goes on to then have PE investors.
Yeah, I
Those are
mean, one way
broad
to look at it is, I've read there's a lot of statistics out there, but the ones that stick out in my mind are, only 10 to 20% of all venture-backed companies successfully exit to an acquisition or a IPO. So
Yeah.
you can kind of think about that acquisition piece being where PE oftentimes will come in.
Yeah.
But
And then-
it takes a while to get there at times, for businesses, and they may never get there, like Ed said.
Yeah, the PE side, you're looking at businesses where they expect to have about a 80% to 90% success rate. And they're, if you want to use a baseball analogy, I'll use a Mariners baseball analogy.
Oh,
Oh
no.
boy.
PE is like Ichiro. They get up, they get a lot of hits, singles, doubles. They're getting on base all the time. They're moving around the bases. They're going to steal a base here or there, but they're really hitting for average.
Mm-hmm.
And if you've got someone like, we'll call it an Adrian Beltre, because I'm going to give my age, where their batting average, while they were in Seattle, everywhere else was fine. Well, they were in Seattle, might be down around 230. They can hit the long ball, and so they're up there kind of swinging away in the 4-hole, trying to knock out the long ball. So the difference is a venture firm, they're looking for home runs. They're looking for 10x, 12x returns. And they recognize, like Rory said, that 80% may end up at zero, or they'll be lucky to get their capital back. If that was in PE land, that would be catastrophically poor batting average. They want an 80 to 90% batting average, but they're looking for 20, 25% returns, not 1,000% returns on 10% of the portfolio.
Yeah.
But they have more swings at bat, right?
Hard to say. I would say you've got a much larger pool of potential venture entities, just because almost any startup, especially in the tech side, can tend to be a potential venture investor. Whereas, as Rory noted, on the PE side, they're looking for far more mature organizations where they're probably making money. And so it's a smaller universe, a little bigger.
But don't they have, well, okay. I was going to say, don't they have more companies in one fund? Or is that
They
not the
can,
case?
yeah. I mean, let's kind of take it up another level. So we talked about the foundation of private equity funds being the LP investors, right? Well, venture funds also have LP investors, and oftentimes those LP investors have a private equity strategy and a venture strategy. They don't look at them as the same class of investment, higher risk, higher return, like Ed said. So allocating capital from LPs, spans both PE and venture. So, whether the size of the fund or the number of portfolio companies in the fund, that may vary and may be similar across, different parts of the middle market, larger institutional, however you want to put that. It's just a different class of investment altogether. It's a private investment, which is why you kind of put those two in the same bucket. But, as far as the risk return profile, what it comes down to is they are quite different. And, some would say venture being more speculative.
When the ERISA laws passed in the 80s that allowed 10% into
Yeah.
high risk vehicles, does that include both VC and PE or just one or the other?
Ooh, that's a good question. I bet Ed's got an answer to that I don't.
In general, yes, because the risk is driven as much by liquidity risk as it is by kind
Yeah.
of this perception of, oh my gosh, these are small companies. It's really how liquid, how quickly can you turn
They
that
get
security
liquid.
into cash?
Mm-hmm.
And so
Yeah.
that's a higher risk, and so as a result, they generally will fit in that same bucket.
Yeah. And I
Okay.
think, from a founder's perspective too, right? Like, it's more likely that a founder will take on venture investment but give up less of the company to do so. In other words, depending on that series or where that VC investment comes in, founder still controls a lot of the company by design.
Yeah.
When you get towards PE, as we've talked about, PE is mostly taking a control position at that point.
Okay. What are the main things that are similar between VC and PE, and what are the main differences?
So I'll hit the biggest similarity, which is they're both a source of growth capital,
Yeah.
Okay.
or they're both ways that you can infuse cash into the business. One of the biggest differences that is related to that is generally on the private equity side, the ownership, selling ownership is taking cash out of the business and putting it in their pocket. Generally in venture, there's no cash going out of the business.
Right.
It's bleeding, and
Yeah.
they're infusing additional cash to keep it alive and allow it to grow to the next stage. So the they're both sources of capital, but the biggest difference is how that capital is generally going to be used on the backside of the transaction.
Mm-hmm. Yeah. I was just going to add it from slightly different angle is, comes back to the investment thesis for, both of those categories. So look, venture investment oftentimes is just a pure bet on an idea or a founder that's been successful in the past. I've heard of and sort of been close to businesses that are not only pre-revenue, but like pre-product. So you
Yeah.
basically are dealing with a serial entrepreneur that people put trust in, and they're willing to roll the dice that, hey, this person's done 3 businesses and exited successfully. Why can't they do a fourth? And I'm willing to put some money behind that. PE is a much different approach, I would say. Not to say that they don't bet on management teams, but it's more management team and also a viable business, and not only viable business, but profitable at the time they invest. So I guess a simple way to think about it is maybe you know and we've talked about it. To be attractive to a PE group, you've got to be generally cash flow positive and have a certain amount of revenue to start before it makes sense for a PE group to come in.
You have to be a little bit more proven.
Yeah, that's a good way
Yeah.
to put it. Exactly right. Yeah.
Okay. I think another thing people hear tossed out are like Series A and Series B and Series C. And in my experience, the way those are used really depends on the VC fund and like the exact situation. There's no
There's
like
no universal.
standardization.
Yeah.
It's
Yeah.
just the order in which
Yes,
they're closed, A, B, C,
I had
D.
an argument about this today with a client of mine. It was like, there's a perspective that it has to do with how much money's been raised to date. There's a perspective that has to do where the company's at as a business in its own life cycle, So yeah, it really is just a sequential rounds that are priced basically.
Yeah, normally your A round is going to be your first institutional round, and before that are going to be seed rounds.
Yeah.
To essentially seed the business, to get it to plant the seeds, and then it starts to grow. And then
Okay.
you've got A through Z rounds after that.
Yeah.
But I've seen some cases where like it's just at the discretion of the fund. There's no like you hit this. Sometimes I've seen you hit this milestone, and then that opens up the potential for further funding. But I've mostly seen it at discretion. Is that what you guys have seen, or other models?
Yeah, it's, as you say, it's kind of a discretionary thing.
Okay.
Different targets and milestones for different businesses and different funds. There's no universal.
No.
Okay. So let's move into PE. So let's do kind of like a recap really quickly. So founder starts a company, like it's just an idea and a dream. And then they get family and friends money and they start a little office in their garage. And then they get pre-seed money, or does angel investor can come in there
Angel,
too?
seed,
Angels, pre-seed,
friends and family. That's all kind of the pre-institutional money.
pre-institutional money.
The handshake type of deal, like the back of the envelope, let's pass the hat around and get some money in. Yeah.
But if you've got like VC, like if you're in your Series B, like you've got like an office, you've got people, you've got recruiting and hiring and teams going on. And then there comes a point where I guess about 20% will say, okay, we want to take a look at taking on additional investment from a private equity fund. What does that transition look like? What does that decision look like? How, when, why would you do that? Ed, go.
Interestingly, a lot of times you're not going to see those two streams cross early. Right. So generally what you're going to see is a company may be initially VC funded and get to a certain point, go public, then begin to kind of stagnate as a public company. And at that point, they may get picked up by private equity and taken private.
That's right.
But you tend not to see a VC-backed company. Again, you will have VC-backed companies that zombie themselves, where basically they get up to a certain point, they're spending enough cash flow where they won't die, but they're not spending enough cash flow where the private equity guys are looking at this as a really good investment for that fund. They may at that point flip it out to a private equity fund that is looking to either kind of bring that technology or that company into their portfolio, generally as a strategic acquisition.
Strategic buyer style.
Yep, for one of their portfolio companies. But the two tend to, once you kind of start off in the venture world, you're generally going to fly or die. It's either taken off or you're going to blow up. And if you, in the private equity world, you've generally bootstrapped yourself to the point where, the company's gotten to a point where private equity sale becomes a method of gaining liquidity for the ownership, as opposed, and you're growing at a nice steady 25, 30% annualized rate as opposed to 300% annualized rate.
30. Yeah.
Yep.
So is it more likely that like as a founder, you would build a company, forego VC funding because you're doing fine by yourself. You have a proven product and company up and running, and then you go direct to PE?
Yeah, you would not see. I mean, interestingly, the way you frame that up provides a really interesting insight into who goes for what.
Yeah.
If you have the capital to bootstrap your startup to the point where you can get the PE, VC wouldn't even look at it. VC looks at companies where it's like, if this thing takes off, we need to just pour capital on this thing until, we're watching the flames as it burns, but we know that at some point this is going to turn into a rocket ship. They're
going for the moonshot.
Yeah. And so normally a typical founder doesn't have the capital to do the moonshot. Yeah. And so that's where the VC comes in. If they have the capital, they're probably at a good, steady, solid growth rate, that 30% growth rate, 40% growth rate. they're self-funding, and that's a classic PE type structure. That's a classic PE type target.
Yeah.
Okay.
Because again,
And
remember what we talked about, with private equity, so much of the deals that they do are dependent on adding leverage to a business where, if you don't have cash flow to support a, newly issued debt, then, it's not going to work. And that's largely the case for a lot of startups that are literally have no cash, so,
yeah.
or they're burning through cash at a clip that's not going to support a bank loan, so.
And the way the math works for like the VC fund is, let's say you have 10 companies and you just know statistically 9 of them are going to just crash and burn and be nothing.
Mhm.
But the 10th will do a moonshot. That and the gains on that one will cover all the other losses that you've taken out of the 10. That's kind of the game they're playing.
Cover all the losses plus give you a 30%
Yes.
return.
Yeah.
Yes.
Yeah.
On the entire thing.
Yeah.
Yes.
Yeah. And there's there's no other way to say it. There's just a different feeling about, optimism in startups and venture-backed companies than a PE. A PE is much more approached as kind of like a financial play rather than like a growth story, that sounds very qualitative, and it is, but I think that's a reality. People tend to be either venture people or PE people. I've recently begun working with some really early stage companies, and it is completely different than my experience having worked in PE for 20 years. It's definitely a different perspective. Not one is not wrong or one is not
Right.
better. It's just different.
Finance guy does not like the burning cash flow.
There's yeah. I mean, yeah. If nothing else, burning cash is it just no matter what, it never makes sense to me. But
yeah, kind of going back to the analogy I used earlier on the baseball side, on a VC, you're generally going to have, they're not going to have a 1 in 10. They're likely to have about a 400, a 40%. But of that 40%, if it's 10, the 4 that actually don't flame out, you're going to have 2 zombies in there that are basically they're going to be surviving, but they're not going to give them a real return. They may have a negative return, but they won't die. You've got one that's going to be a nice, 30, 40%, 50% annualized return. And then their goal is to have 1 out of 10 or 1 out of 20 be 1,000% return, 10x, 20x. And that's really and then you're going to have 4 or 5 of them that are not going to even, they're going to go to 0.
Mm-hmm. Yeah. Yeah.
Yeah. So wait, in your analogy, was Ichiro a PE firm?
No, Ichiro's more of a PE firm. He's really he's hitting for singles and doubles. It's on base. It's moving around the bases.
And it's more predictable and consistent.
Yep.
And if you have a good stretching routine and habits that you do to get yourself, your swing might look janky to an American audience, but it works. So keep doing it. Amazing. That's Ichiro. Okay.
Yeah. And the other side to the equation on the private equity side is, if, like I said, if they end up with a 40% hit rate, they're failing. They're failing hard.
Yeah.
I mean, they should be in the 80s to 90s. But the concept where you've got this strange area where the two will play with each other, like I said, is like the zombies and that's a technical term in VC, the zombies where they just won't die, but they're not good enough they're not alive and they're not dead. They're just kind of there doing their thing, but they just, and I've got one of the companies I'm working with now is a zombie. It's essentially a company where they're down to their last 4 or 5 employees. They've got, they're got enough revenue to pay the bills.
Yep.
They can't grow and we're not shutting them down. And so they're just kind of cranking along at a break even.
Yep.
So let's take the analogy of 10 companies, and I just picked 10 because it's easy math.
Yeah.
So where the VC wants one of them or a small percentage to go 1,000%. For a PE firm, the equation's almost flipped, where it's they'll take 1 or 2 clunkers, but the rest have to hit at 2 to 5x. Is that generally what's acceptable?
2 to 5 is pretty legit over a 5-year hold. And even the clunkers are generally, my experience, and Rory and I have worked with some of the same private equity firms. Even the clunkers are underwritten so that if they have to liquidate them, zero.
That's what I was going to say. I mean,
you're still going to be able to sell out of those and get.
They make it so they can't
you
lose.
would have
It's
some
You might get a
managing
point.
directors at a VC firm literally say, you know, I'm looking for that 1 or 2 out of 10 to really hit. You know, zero managing directors at a PE firm is going to say, I'm going to be accepting 1 to 2 losses in my portfolio. They're not. They're going to be like, I want about 1,000. I may make, you know, 1.5 to 2x on a couple of these, but I'm making money because I'm going to financially engineer my way out of a return or into a return, no matter what.
Yeah. The one private equity firm that the three of us all worked with, when I would go to their annual meetings and get a chance to take a look at what the performance of those portfolio companies were, out of like 70 across 4 funds, they may have had 2 that went to 0.
Yeah. Yeah.
And sometimes they'll flip them into dividend plays, which we can talk
Exactly
about.
right.
They like the timeline stretches way out and they just take dividends month over month. And the whole thesis and how you operate that company changes, but they can flip them into that.
Yeah, we call it turtle mode in that case. Yes.
Turtle mode. I love that. Okay.
That's an Ed
turtle
term.
mode. Oh my
Turtle
gosh.
up.
Turtle up.
But I remember us three talking about like, hey, we were at this place with the PE firm, and out of like, I think it was 12 companies in our fund. I can't remember, but we didn't want to be like the very last, certainly, but we didn't want to be like the very first. There's like a sweet spot where if you were like second or third best, like they just keep giving you what you need, like anything you need, like let us know, but like they let us run the company.
I've
And
never
that was
worked
like
for one of those where you
spot.
keep getting whatever you need. I guess I've always
that might
been
be a bit of a
middle
that
or
might
back
be a
of the
bit of a
packer or
stretch.
something like that because it's always been a grind.
Yeah, that might be a bit of a stretch, but yeah, the one the 3 of us worked at was a solid performer. It was mid pack for
really
that
good.
fund.
Yeah.
And we were largely left alone. There was always pressure. How are you going to grow? How are you going to get the
Sure.
return? How are we going to, they would relever the thing. And I'd be like, stop, I'm getting panicked because you're going to screw up
I need some
just
breathing room.
We're just getting comfortable. And now you're going to throw additional leverage on dividend crap out.
Yeah.
And that would be, but you're fairly much left alone. Now, the last PE back company I ran, we were the runt of the litter. And, we were not left alone. And it was, calls multiple times a week on where's the revenue and how are you going to cut more expenses? And, again,
you don't want to be at the ends, like the extreme.
Well, I don't mind being at the top.
Doesn't that come with its own pressure though?
It does, but that pressure is good pressure because you're going to get paid. You're going to make it rain.
Okay. The worst is when it's an absolute grind and you're like, I do not see the carrot at the end of this stick, or the light at the end of this tunnel, whatever analogy, or pot of gold at the end of this rainbow.
Some of them get like real excited by the leader, and it's like, okay, I was good with like a 3x, and now I want like a 6 to 7, and they go crazy with it because they think they can like make it more. And it's like, just stick with the program, double down on stuff, and let's get a really good return on this.
Yeah.
Like 5x is a good return for everyone. That makes everyone happy at the end of the day.
Yeah.
Okay.
But in the VC world, that's not how it works. It is you're driving hard all the time until you blow up or grow up. And you've really got no, and it is like a marathon at a sprinter's pace.
Yep.
There is no turtling up. You will blow up or grow up.
You're the hare, man. You are not you're not the tortoise in this case. You're the hare.
Yeah, you need to be a hare with your butt on fire, running as fast as you can.
Yep.
Okay, so let's just say, like, I know the probability is low, but someone has pre-institutional money and then PE money. Let's just say that.
Okay.
How does the makeup of like the waterfall and the board seats and all of that go down when you have like an initial round of funding and investment, and then you have PE come in? How does that all get shaken out?
So I'll give it depends. Rory and I went through that exact scenario where we were at a company that was essentially angel backed.
Yeah.
By folks as famous as like the chairman of the Federal Reserve was a partner of one of our board members, a retired chairman of the Federal Reserve. So it was a highly sophisticated board. They were angel investors. Their investments were 7 figures, and it funded a very, very, very successful company. When the
It's always
PE
funny
guys,
how money has a way of sniffing out more money. You know what I
yep,
mean? Like
yep, follow the
just,
smart money.
yeah, exactly.
And the when the PE guys came in, a number of them took the money and left. But what the founder did was he essentially negotiated a second board seat. So he said, I've got two board seats, and he took one of the more sophisticated board members of the folks who cashed out and brought him back on as a board member.
Yeah.
Well, otherwise it becomes kind of a negotiation during the deal of, okay, how many board seats are there going to be? What percentage sold? And then, is there going to be a pro rata allocation of board seats? And depending on what that pro rata percentage looks like, you may end up with a board that expands from 4 to 14, or you may end up with a board that goes from 4 to 5, but the old board reduces down to 2 seats and the PE guys come in with 3 if they got majority control.
Do you want to quickly explain pro rata?
Yeah, it means in proportion to your ownership percentage.
Yeah.
In that particular case.
That's why you hear dilution in that term so much on the early stage businesses, is because you just keep splitting a company up in terms of allocation of ownership, but you got to be really careful as a founder how much you're giving up for how much money you're taking on. I feel like kind of at the private equity level, it's a little, you've already done that enough, and at a point it becomes a little more straightforward at that level. But yeah, like early on, it's every dollar you take on, you got to be very careful about what you're giving up for that dollar. But it gets harder to justify that based on how do you value your company that's pre-revenue, pre-idea, pre-whatever, So
yeah. So would you say, you mentioned this earlier, but at the VC phase, the founder is still largely, quote unquote, in control. Like are they the majority owner? They're like the head of the board. They can make decisions about who's on the board and decisions about the company.
Typically all
and
of the
things
above,
like this.
yeah.
And then when they move into PE land, things change.
Even on the venture side, things will change. There is a tipping point where the founder is diluted down to de minimis amounts, but that de minimis amount may be, still a very lucrative percentage. They may have
smaller piece of a massive
it's
pie,
normally,
right?
it's normally when you've got something going to the moon. So everybody wants on board. So you hear about the things like Facebook where like Zuckerberg still got control because he's got restricted shares that have super majority rights or super majority voting rights and all this other stuff. That's unusual. And that becomes possible only if that VC backed company takes off like a rocket ship, is a rocket ship. And when you're going out for subsequent funding rounds, you're pricing those at a premium price. People are clamoring to get on board, and you're the seller becomes the dictator of terms, as opposed to really having to go out like in PE. Normally you're going out like, I'm selling the company and you're doing the window dressing and stuff. Some of the VC backed companies, when they're taking off like that, when they're a unicorn type company, they're going to end up where they are in the driver's seat as to what those transactions look like.
Yeah. I mean, most of the time it's like a founder in their basement saying, please give me any funding you can. But I think Rory mentioned earlier, like if you have a proven entrepreneur who just like is serially like successful and they're doing their next big thing, VCs like want in on that. So the dynamics flip a little bit. If a founder's listening to this and wants to kind of keep track of, okay, I'm kind of hearing like VC as an option, or I could go straight to PE and grow it myself. And there's just different trade-offs. There's no right or wrong per se. It's just your setup and again, why you're doing it, what you want. What are some other things that they should be thinking about?
There is a right or wrong. Actually, I'll disagree with you. There is a right or wrong.
Yeah, I know where you're going.
The right is you have to pick which kind of choose your adventure wisely. So it's if you are a rocket ship, or you think you're going to be a rocket ship, or your business is structured as an idea that could be 1 billion people want to do it, VC is the only way you're going to go. It's the only folks that are going to listen to you. It's the only people who are going to be willing to write a check to watch you burn it with the hopes that you're going to achieve $1 billion or $1 billion valuation. On the PE side, if you bootstrap the thing, or you're like, I don't see how this becomes $1 billion company. This is a good good business that's got a good niche that's going to really grow, that could grow at 20, 30, 40% a year with some capital and some expertise. That's a PE backed business. Venture is not going to be interested, and you can burn a lot of time, energy, and effort trying to chase the wrong money.
Yeah. Or chasing any money, to be honest. So, I mean, I'd say I thought we were going to go here. I agree with what you said, but I would also say the other right answer is bootstrap it all the way. Don't take on extra money. Don't take on outside money. If you can get it to the point where you don't need that, like, operating cash flow or should say, outside investment just to keep the lights on, and you can bootstrap it to the point of, PE level growth capital, do that. Don't mess around in the middle. Like, if you can bootstrap it. It's going to be best for your outcome. You're going to retain the company much longer and have much more leverage, and won't have to give up as much along the way.
Okay. If someone is entertaining VC or PE money, what are some things they should look at to protect themselves in terms of, like, I don't want to get diluted, or I don't want someone to put one past me where they give me like this template I don't understand, so I sign it. What are some key things they should look for?
Well, going back to, I believe a couple episodes ago, we said, get your team around you. You want to be working with good lawyers, good advisors, to help you along the way. If you try to, if you're not experienced in these things, you will get taken to the cleaners. So make sure you got good representation as you cut a deal. I mean, that's the first order of business.
Yeah, there's a couple other things even before or in parallel to putting that team around you. The first one is talk to some folks who have been there, done that before from the founder's seat. So there's, different, especially in areas like Seattle here, where you've got a lot of founder built businesses and folks who have gone through this exercise and succeeded and failed. You've got resources to be able to kind of sit down and hear the stories. I mean, you're hearing our stories and we've been through it. There's here in, if you just think about Seattle alone, there's probably 5,000 other people who could sit down and have similar conversations. Pick those brains. The other is there's a lot of, and kind of shameless plug for the book, but there's a lot of books out there that, talk about the private equity. We not a lot on private equity, which is why, we're so good at helping people, but there's, private equity and a lot of startup, how to fund your startup and, some of the private money and how to raise seed rounds. They're not going to get you from here to there. And there's no replacement for having the right resources around you, but they will give you an idea of the environment, the type of questions to ask, and kind of at least a framework from which to be able to operate. And so I'd recommend that in parallel with trying to determine who your advisors are and make sure you get a good team around you.
Yep.
All right. So assemble your team, get your resources going. There's places like Startup Grind in Seattle that's literally for founders doing the startup thing, and they have tremendous resources there. There's platforms like Y Combinator where you can get connected with the people you need to. Podcast wise, you're in the right place. So great job. And then book reading wise, there are dozens, probably hundreds, but the one you want to start with is On Ramp to Exit. And we'll have a link for that in the show notes. It's available on Amazon and anywhere books are sold. And we will catch you next time on the Private Equity Experience podcast. Thanks, guys.
Thank you.
Thanks, Em.
If you enjoyed today's episode, please like, share, and subscribe wherever you get your podcasts.